Welcome to This Explainer. Today, we're diving into a genuinely defining moment of modern history, the 2008 financial crash. We're going to break the whole thing down step by step and really demystify this massive, complex financial machine that literally brought the global economy to a dead stop. So let's jump right in.
Section 1. The Overnight Collapse. September 2008. We're going to start our story right at the dramatic end, with the sudden, shocking death of a financial titan. That titan was Lehman Brothers. Now, this wasn't just another bank, it was a cornerstone. Lehman had a staggering 158 years of powerful, uninterrupted history behind it. I mean, think about that. That is over a century and a half of surviving civil wars, Great Depressions, and countless market panics.
But then, overnight, that massive 158-year legacy just completely vanished. Gone in a single weekend. And the executives running it? Well, they either didn't see it coming or, maybe they did and just looked the other way. But the real tragedy here is that when Lehman fell, it didn't just wipe out hedge funds and Wall Street traders up in their glass towers. No, it wiped out ordinary, hardworking people who had done absolutely everything right.
Section 2. The Mortgage Machine. Let's rewind to the 1990s.
To really understand how this entire global disaster happened, we have to look back at the booming economy of the late 90s. This was a pretty unique era. Politicians from both sides of the aisle, along with the government, were pushing this beautiful, almost poetic idea that home ownership wasn't just a dream, it was a fundamental right. Because more home ownership meant more stability, right? So banks were heavily encouraged to lend to people who, even just a decade earlier, would have been turned away at the door. And to handle this massive influx of new mortgages, Wall Street basically invented a new machine. Here's how it worked. Step 1, a bank issues a loan. But instead of waiting decades to get their money back, we hit step 2. They take thousands of these individual mortgages and bundle them all together into something called a mortgage-backed security, or MBS. Step 3, they sell that massive bundle to pension funds, insurance companies, and investors all over the globe. Why was this genius in a twisted kind of way? Because the exact second they sell it, the bank can completely stop caring about whether you actually pay it back. The risk is suddenly someone else's problem, which leads us right to step 4. The bank turns around with fresh cash and just makes another loan. This machine constantly needed fuel, and mortgages, well, they were the fuel.
And because this machine constantly needed to be fed, lending standards basically collapsed entirely. They just had to keep creating new mortgages no matter what, which led to the creation of the infamous ninja loan. I'm not kidding, this is literally a mortgage granted to someone with no income, no job, and no assets. NINJ. Banks were handing hundreds of thousands of dollars to people who so clearly couldn't pay it back. Now, the borrowers weren't stupid. They were often just desperate or really hopeful, and they were constantly reassured by men in nice suits who promised that housing prices would only ever go up. But of course, nobody bothered to tell the borrower that the guy in the suit collected his commission the exact second the papers were signed. To put the sheer scale of this danger into perspective, it's honestly alarming. By the mid-2000s, nearly 20% of all mortgages issued in the United States were subprime. That is almost 1 in 5. A massive chunk of the entire American housing market was built on loans given to people with poor credit, designed at some level to be incredibly difficult to repay.
Section 3, Complex Financial Phantoms, Slicing the Risk.
So let's look at how the financial sector took these highly risky subprime loans and deliberately hid the danger from the rest of the world. Wall Street took those mortgage-backed securities we talked about and sliced them up into incredibly complex layers called CDOs, or collateralized debt obligations. The absolutely crucial point to understand here is how these risky bundles were graded. The top senior layers of these CDOs were stamped as AAA safe. That literally means they were supposedly as secure as U.S. government bonds. But here is the fatal flaw, the real kicker. The rating agencies stamping that seal of approval, companies like Moody's and S&P, were being paid by the very banks whose products they were rating. It's exactly like the people grading an exam being paid directly by the students taking it. And absolutely no one in power stepped in to say, stop.
And you know what? The products just kept getting more and more abstract. By the mid-2000s, Wall Street actually started creating CDOs of CDOs. Yeah, you heard that right. These were synthetic instruments that contained absolutely zero real mortgages. None. They were just abstract bets on other people's mortgages. The products became pure financial phantoms, essentially turning the entire housing market into a massive global casino.
And sitting right at the center of this massive web were credit default swaps.
You can just think of this as financial insurance. Say Bank A is worried a bundle of loans might go bad, so they pay Bank B a fee, and Bank B promises to cover the losses if it actually happens. Sounds totally normal, right? Well, except for one tiny detail. There was absolutely no requirement that Bank B actually hold the money in reserve to pay up. None at all. Insurance giants like AIG sold hundreds of billions of dollars worth of these swaps. They were out there writing massive checks they had absolutely no actual accounts to cover.
Section 4. The crash and bailout. The system breaks. We finally reach the inevitable tipping point where the fuel runs out, home prices stop rising, and the whole unstable structure just starts violently shaking apart. The escalation was incredibly rapid and honestly terrifying. In 2006, the very first cracks quietly appear as home prices peak and begin to fall and borrowers start missing their payments. By 2007, two Bear Stearns hedge funds completely collapse. Then, early 2008 hits. Bear Stearns itself, a massive institution with 85 years of history, plummets from $170 a share to being bought for a humiliating $2 a share in a frantic Fed-orchestrated rescue. And finally, we hit September 2008. The U.S. government decides that this time, they're going to let Lehman Brothers fall, which triggers a catastrophic $613 billion bankruptcy.
The market reaction? Immediate and totally devastating. The Dow dropped 500 points in a single day. Money market funds, which, by the way, millions of regular Americans used just like regular savings accounts, began to crack. This triggered a terrifying run on the shadow banking system. Institutions yanked their money out all at once, from absolutely everywhere. Global credit, which is literally the oil that keeps the global economy moving, completely froze. Banks wouldn't lend to each other. Everyday businesses literally could not borrow the money they needed just to make payroll. In the span of about 10 days, the global financial system came within hours of a complete and total seizure. So in an act of pure desperation to stop the bleeding, the government stepped in. The Federal Reserve pumped hundreds of billions of dollars into the system. Congress passed the massive $700 billion TARP rescue package. And AIG, they received a staggering $182 billion government bailout. Taxpayer dollars were being used to rescue the exact same institutions that had built this reckless system in the first place, saving promises that taxpayers never even knew existed.
Section 5. A crisis of trust. The human cost.
We really need to look closely at the aftermath here, because while the giant banks mostly survived thanks to these unprecedented bailouts, everyday people definitely did not. It's a really stark, agonizing reality. On Wall Street, bailouts were successfully secured, executive bonuses were kept entirely intact, and out of all the people who built these systems, only one mid-level trader served meaningful prison time. Remember, the system was technically mostly legal, encouraged by regulators and economists who confidently assumed house prices could never fall nationally all at once. But then look at Main Street. 8 million jobs lost, 4 million homes in foreclosure, $13 trillion in household wealth wiped out in just 2 years. Hardworking families who spent decades doing exactly what they were told lost absolutely everything. The architects of the disaster walked away wealthy. And the public? They paid the ultimate price.
Which brings us to this incredibly poignant summary. It was a system optimized for short-term profit, running at full speed with the guardrails quietly removed. Ultimately, what this explainer shows us is that the 2008 crisis wasn't some grand secret conspiracy in a smoke-filled room. No, it was something far more dangerous. It was a catastrophic failure of manufactured trust. Trust that the ratings were honest, trust that the insurance would actually pay out, and trust that the people running these enormous institutions actually understood the immense risks they were taking. Spoiler alert, they didn't. This entire disaster was aided by continuous deregulation, one approved product at a time, and a willful, almost stubborn blindness to risk.
And that leaves us with a final, haunting question. We know exactly how the machine broke, right? We've seen the instruments, the failures, the complete lack of accountability. But the underlying nature of the system, that relentless drive to move money fast and obscure risk, well, that remains a core part of the financial world. So as you process everything we've unpacked today, just let this linger. What makes us think it can't happen again? Thanks so much for exploring this vital piece of history with me.